Hello and welcome to Young Turks, India's longest-running show on startups and entrepreneurship. I'm Shereen Bhan. On this episode, we bring to you a revelation and decipher the Omega Files, a 96-page report that sparked charred chatter in every corner of Startup Street. Released by early-stage venture capital firm Blume Ventures, the Omega Files, in its essence, punctures the mystery and intrigue of startup investing, the successes and the failures too. In an unprecedented move, Blume Ventures has declassified the performance of its first ever fund, for which it raised about 120 crore rupees over a decade between 2011 and 2013, in an era where venture capital was less discussed and the term unicorn was yet to be coined. It was first ever private Indian VC fund raised or closed with 100% domestic capital. As of December 2023, Blume has realized 5x of the invested capital. It's also projecting to close at 6x gross by full exit early 2024. Now, with the Omega Files, Blume Ventures aims to herald an era of transparency for the Indian startup ecosystem, bridge the gap between public and private markets, and make startup founders more responsible, placing their names out there for doing things right or even not so right. Before we bring in Karthik Reddy, one of the two founders of Blume Ventures, to talk about the Omega Files, let's first go down memory lane to 2013, when Young Turks first featured the VC team as it was building its portfolio from its first fund.
It's the most rewarding and can be the most frustrating thing to be an entrepreneur. Stay the course, surround yourself with the best team, fulfill a customer need, and everything else follows.
The measure of success comes from a conviction in an idea as opposed to the number of followers it has. That's what we look for in entrepreneurs.
Founded by two former members of Mumbai Angels, India's first angel network, Karthik Reddy and Sanjay Nath gave up their day jobs in 2010 to start up on their own with Blume. And perhaps the best way to describe what Blume Ventures is looking to do is to say that they've put angel investing in high-speed mode. Angel investors Karthik Reddy and Sanjay Nath conceptualized Blume in 2010. Spent the next 10 months talking to over 300 investors and high-net-worth individuals, of whom 55 helped them raise India's first all-domestic angel fund.
People say friends, family, and fools, in a sense, FFF. After that round and before the VCs, there's a huge gap, and the model is basically ready to fill that gap.
At 100 crore rupees, Blume has an investable capital of 80 crores, and almost half of this has already been invested, and Karthik and Sanjay have an interesting strategy at play.
We can't fund every good idea that's out there, but we want to maximize that. So we came up with two strategies. One where we call ourselves lead investors and do at least half the round, if not more. So, and the other where either we don't want to make a large financial bet or a large time bet to a set of entrepreneurs, but we like them. And we would want to sort of share that risk with capable co-investors.
And it's a fine balance for the Blume team as well when they're managing a portfolio of 40 ventures. What helps them prioritize is knowing that they have just 12 to 18 months to get it right.
There's no question of walking off because, again, fundamentally it's not my money to do that, right? There is a fiduciary responsibility, so I have to take care of whatever I can get out of that investment. But time is as much of an investment on our side as the money is.
Well, no question of walking off. He's walking forward. That was Karthik Reddy in 2013 on Young Turks, the co-founder and managing partner at Blume Ventures. Karthik, many thanks for joining us. A decade on, you look exactly the same.
Thanks, Shereen. Thanks for having me, and thanks for digging that piece of history out. It was a walk down nostalgia lane, literally. But we still, by the way, we went and took that old office back, so it's all come back a full circle, just like our fund life and fund performance.
Wait, that's good to hear, Karthik. But let's now talk about the Omega Files and your decision to go public with the performance of the fund and why. And I know that in your blog you said that the most common question you've been asked in private DMs is, but why did you do it? For those who don't have access to your private DMs, Karthik, let's put it out there. Why the decision to go public with the Omega Files?
I think it was brewing for quite some time in our collective heads. I felt like there were a lot of firsts in our sort of journey. When we started, we knew how difficult that journey of convincing Indian investors to invest in a new asset class, where, by the way, it's all played out the way we told them the story. We actually said we might lose half our investment bets. And people were appalled that that could be an investment manager pitch. And despite that, to their credit, almost 80 investors in that first fund essentially said they'll give us a chance. So it was a very, sort of fulfilling entrepreneurial journey. But it felt like if the story wasn't told, it would belie the challenges of, what it took to build a venture fund in an era 10, 12 years ago. And what's happened, Shereen, if you notice, is about, if you recall those years, there were only 7, 8 of us who were homegrown, early stage funds raising between 25 and 200 crores, very small. Today, we are 290 million, but there are literally my colleague is mapping out and putting out a blog next week. There are 100 such funds. There are 100 new Blumes in the ecosystem. And you don't want them to make the same mistakes in some sense. You feel like, we went through that journey. It's a very different environment. A lot more people are there to take the risk. But it's not about just the LPs. It's about, what does it take to be able to get the returns that the LPs are looking for, and what should be the portfolio construction. What kind of outcomes do you need to be able to make 4 or 5 times your money? And usually all this is there in theory. But sadly, how well theory translates to practice is never actually documented. If it is, it's in some cozy private realms which are shown to institutional investors, and nobody gets to see what actually happened. So we thought it'll be a little bit of our way of telling that we did our investors, or we gave our investors their fair due and returns. We sort of paid back the trust they put in us, and also sort of set a sort of template, and perhaps try to be a role model for young managers who are starting today and who aspire to become the Blooms of next decade, right? And so that in totality makes the ecosystem come alive. Not like a 5-10 of us winning is not going to make a country the size of India come alive. Yeah. So it's a bit of all of that.
I couldn't agree more with you, Karthik, on the need for greater transparency and better communication, because this is a grouse that I've always had with the startup ecosystem. You can't hide behind the veneer of saying we're not public and we don't owe anybody any information, or we'll give you the information only as we deem fit or as we deem appropriate. But, Karthik, you talked about how when you started there was just a handful, and today there are 100 new Blooms, in your words. But what would you say has been the biggest change, especially when you talk about fundraising, especially when you talk about the conversion rate? I remember, from the Omega files, you talk about the conversion rate where 1 out of every 6 LPs pitched ended up investing in the first fund. How much of that has changed? Is it a arduous sales pitch still, or is it easier to raise?
No, I think it's arduous. I don't think it's that easy. It's just that two things have changed. One is wealth managers have gotten familiar with the asset class, understood it through investing in Blume and maybe 10 others. So they're well informed when they're advising their clients. Clients are moving from potentially high net worth individuals and ultra high net worth family offices, have probably moved from 0, 1, 2% of their aggregate wealth allocation to venture to maybe 3, 4, 5%. And if you go to tech entrepreneurs who didn't exist with their exits and hundreds of millions of dollars back then, they've emerged in multiple corners of the country. And when you look at them, they actually overweight. They put 25, 30, sometimes even 40, 50% of their wealth into tech, because that's where they made their money. They want to give back. That's what they understand. So when you take the cumulative wealth that's willing to participate, forget about 2011 to 13, even 12 to 18, which was phase 1 of the AIF Cat 1, Cat 2 industry, 10x that money came between 2018 and 2022 into AIFs in Cat 1, Cat 2. Right? So there's been a huge upsurge in interest, right? The reality, though, is it's not about simply the money coming in, which has been the perpetual complaint about Indian, private markets. When will it pay back in spades? So I don't think Indian HNIs and Indian investors are any different. They want to see that cycle play out. So in a sense, we actually wanted to show that it is possible. And it was possible, and we pulled that off, albeit it took a couple of years more than we would have liked, but we managed to pull that off in an era where nobody thought it was possible at all. I mean, literally, some of the people patted me on the back and said, "You look like a nice guy. Here's 1 crore. I don't know if you'll actually make it through. If you return a capital, we'll say well done." And as late as 2015, I mean, I can imagine them saying that in 2011. After 4 years of portfolio construction, also they didn't believe it might happen. So I think that it was a sense of fulfillment to be able to say it out loud. And I think I needed to, at least at a personal level, I can speak for some of my early team. I think we need to get it off our chest. And the more interesting thing, or more daunting thing for me personally is that we've kind of implicitly committed that we'll continue doing this for another decade. So I don't know how scary that sounds to me already, but we'll see. And the point you made around public disclosure, I feel in general, my entrepreneurs tend to take my advice seriously only if I'm practicing what I preach, right? So I can't on one hand tell them, public markets are daunting, but that does not mean you shouldn't go IPO. You should build for 20-year journeys. You should start preparing for IPOs in 8-10 years and continue building for 10 years after that, which all means everything you said, with disclosure, being naked out there in the public markets. But then I can't hide behind a cloak and say, I will not do all of that myself. So it felt like a much easier win in those conversations with my entrepreneurs if I did it myself. So it serves many purposes, as I wrote in my blog today. But it fulfilled a lot of sort of future needs and how we want to build Blume into the next decade and beyond. So I think that was the motivation, to be honest.
No, and I think it also does a service to to building out this asset class and the way that we've seen it evolve and the confidence that has grown in the startup ecosystem, in the Indian startup story. But Karthik, let's talk about some of the lessons, some of the learnings, and some of the sort of revelations that we've arrived at through the data that Blume has put out. And I want to pick up on one of the interesting ones. India's Silicon Valley, Bengaluru should have led returns, but it hasn't. It's actually been the Delhi NCR companies that have yielded the most substantial multiples versus all other cities. Now, why do you believe that's the case? Because Bengaluru gets the disproportionate amount of mind space and media space as well. But in terms of returns, it's Delhi NCR that's delivered better.
I trust you to pick the most controversial one. I think the Delhi NCR folks are sort of rejoicing, but as you and I know, it's one data point. It's one vintage. That said, Delhi continues to do well. I think Delhi entrepreneurs and Mumbai entrepreneurs are underrated when it comes to their ability to have that long-term orientation as entrepreneurs and build beyond IPO and build beyond 10 years. Bangalore was a relatively speaking, a smaller, newer entrepreneurial ecosystem when tech started in a big way. And I think they're waiting for their role models to emerge. I think it's inevitable it'll happen. In Indian hands, maybe Flipkart would have gotten there. Now it's Walmart owned, so they're taking their time. So I think more and more Kampola is getting there, I guess. And so I think a lot of ecosystem building, Shereen, is about role models, right? And they haven't been as visible till 4 or 5 years ago. Even if you look at the recent IPOs, they were all, Policy Bazaar, Nykaa, Zomato, they're all Delhi Bombay companies, right? And so I think it's just a matter of time before Bangalore shows up. So I think you're right, they get a disproportionate amount of noise, and it's time that they actually showed that they're worth that attention. Yeah. But there's no denying that the buzz is definitely in the city. I'm actually sitting there in my Bangalore office today, so the buzz is here, but they need to show up with a lot of cash returns, not just paper returns.
Well, let me pick on another controversial revelation from the Omega files then, Karthik, and let's talk about whether the pedigree of the founders matter or makes a difference. What does the data reveal on that front?
Yeah, so it's funny, right? So it's not like I'm trying to build a slide to sell a narrative. we asked for my colleagues and my young colleague Aditya and his interns to say, tell me what the data said, because I've never given it a thought company by company and looked at every piece of data. And this is what the data showed. And then they said, hey, we're putting out all of this because it's super controversial. I said, but there's nothing to mask. The whole point of the Omega files is to declassify everything. And so there's no hiding. So let's put it out there. And then the interesting nuance that you saw there was, for what it's worth, Blume didn't have much of a bias in picking IIT and IIM grads and postgrads. And, probably in our picks, only 30% or 35% of founders came from there. But the returns were disproportionately from those founders, right? So there are two explanations. One is they actually were sold better, executed better, got to Series A, B, C as rightfully so, and then took off and delivered most of the outcomes for Blume. Again, this is one data point. It might be very different in another fund, so let's not overread into it. The other could be an interesting bias that at that juncture, the ecosystem was much smaller. The Series A and B players were a more finite universe, and they had more IIT-IIM biases than Blume did. And so they ended up picking all of the IIT-IIM ones better than the non-branded sort of undergrad and postgrad degrees. And it's a chicken and egg, because if you don't give an entrepreneur money and you expect them to hit it out of the park, it's tough, right? And so what came first? The fact that they didn't get money or they were not good enough to raise the money is difficult to say today. So we'll wait and see. I think what's interesting is I'm prompting others to say, share your data. Let's see what the aggregate data says, right? Not just a dipstick analysis by one media outlet or the other. Let's show actual data vintage by vintage, and we'll get better. By 2030, we'll have all the answers.
By 2030, we'll have all the answers. Hopefully, we'll have more revelations coming our way. But you're right in pointing out that the context is important and the nuance is important as well, as Karthik has pointed out several times through the course of this conversation. But let's talk about the other aspect, and that has to do with the consumer story and the returns or the lack thereof, and whether that indicates a larger overconfidence in the Indian consumer story and how it's played out so far, and what are the lessons to be learned from that?
Yeah. For us in Fund I, again, since you alluded to it, I'm going to take off from the cue you gave me. Context is very important. So in 2011 to 15, this was a pre-UPI, pre-Geo, pre-UID era, and consumers easy to grasp, easy to fund, and people were chasing it with aggression, especially if you remember those days, there were two mini e-commerce booms, and there were two mini e-commerce busts as well, all in a matter of 5-6 years. And here was little Blume writing $100, $200, $250,000 checks in a 500K round, and very rarely would we participate in a round greater than $500,000. But then if you want that company to go and get a Tiger check or an Axel or a Sequoia check back in the day, the traction had to be much more, and you underfunded these companies. So I would take some, I feel a little guilty as well in terms of saying we underfunded a lot of stories that could not have broken out as consumer stories. There were at least 3 e-commerce or 4 e-commerce companies in our portfolio, which died because as they grew, they couldn't meet their working capital needs, and nobody would fund them, right? Because it was inventory-based models back then for a lot of the categories that we were chasing. And if a competitor got a better VC, a Series A VC with $3-4 million, you were dead in the water. On the flip side, the B2B companies, while they were out of fashion back then, especially if you have a software or deep tech, kind of knew those odds before they started, right? So they built very, very, very carefully. And despite a long drought or a very long undeclared winter back then, they thought this was the way business was. And they sort of broke even in large numbers, right? And they somehow sustained themselves through 2016-17 and got to a new orbit in terms of revenue and traction. And then suddenly somebody came and cut a check and they exploded. So we have a disproportionate set of B2B, cross-border, deep tech winners in that first fund. And I will also admit it's Omega Files 2027 are not out, but I'm saying when I do publish them, you will actually see in Fund 2 this reversed. Actually, more consumer startups took off in Fund 2, right? And the B2B ones struggled and fell behind because these macroeconomic trends of UPI and Geo, etc., massively benefited EdTech, commerce, like Spinny, used car service, Flights. They're all Fund 2. And that vintage of 15 to 18 is a rock star vintage for us on consumer, even though we were not cutting very large checks, just $500,000 to $1 million, because the market was willing to back a lot more of those companies. So I think, when we get asked a lot when we go overseas, how do you guys think about portfolio construction? And one lesson I would want to leave behind for your viewers and young VCs is it's very important, therefore, to sort of time diversify and sector diversify in a single fund itself. Because you really, despite whatever you might sell yourself and whatever fad you're chasing, whatever hot trend you ask me for 2024, you really don't know. You don't know what's going to play out in 2030 or 2032. And actually, those are the ones which are going to deliver you most of the moolah. Not what takes flames, goes up in 26 and flames out in 27. That's usually a suboptimal exit. The ones that actually survive through 30 are going to be my best outcomes from Fund 4. So I think our learning or our wisdom has come from diversify within that 3-4 year cycle, both on annual vintages and in B2C, B2B. So that ratio of 60-40 we have not betrayed over any fund life after that. So we're quite happy if we've seemingly missed a massive trend in by not playing more consumer companies in one vintage or less in the other. So I think we're quite happy with the diversification for this reason. Yeah,
I think the diversification point is well made there. Karthik, since we are talking about lessons and learnings over the past decade, let's talk about what's happening on the regulatory front, because you have, of course, written about this in your blog, that while there has been an appreciation, a recognition of this asset class, when we talk about the policy framework or the regulatory framework, there is still not a level playing field. In fact, you believe that it's almost getting in the way of allowing this sector to flourish.
Yeah, I think, so firstly, I think there's a broad brushstroke of dealing with all alternative assets with one paintbrush, right? So we're all under AIF, VC, private equity, hedge funds, real estate. We're all under the AIF industry. And as you know, I also represent the industry association. So I think one is, so therefore it's very difficult to dissect or divorce yourself from the aggregate asset class. And venture, I think, does a lot of technology, innovation, building blocks kind of investments more than any other asset class. However, for all that risk that you take, our perpetual complaint has been that somehow we seem to be taxed more than public markets, which actually has no primary capital formation at all, almost nothing, right? It comes, rides a stock, takes its money out, and they get taxed at half the rate as we do, which I just feel is blasphemous, right? For a country that's trying to break out and become like a $10 trillion economy, they're simply saying, I'll window dress all of the, the innovation stuff through venture capital, but I really don't think you need to get any benefits or not even a level playing field, right? That's one. And second is, whenever as a regulator, whichever regulator it is, if you're thinking about how you treat an AIF, who's my competition? Yes, there are other AIFs, but we're all fledglings. But we're competing with behemoths from cross-border, and they're considered FDI, right? And I simply want to know, am I being given the same terms as them? So you can't tell me to become Atmanirbhar and go and convince my hardworking HNI LPs who have made difficult money with so much difficulty in the Indian context to part with that money and compete with some pension fund money which comes in billions of dollars through other GPs from overseas and has no such shackles or chains, right? And we won't get into a whole regulatory debate on this show, but basically, and by the way, my
that's for another day.
Is actually, I have actually not spoken about, it's not easy, but I want to illustrate what I mean by regulatory differential treatment. And I will hopefully try and show that in the data December 2024. So, to be able to say that if we had the same treatment as X or Y or Z, how much better could the AIF returns look like? And so I think at one level, while everybody wants to protect the investors and the entrepreneurs, I feel we're actually doing a little bit of a disservice to further give them more capital or more returns back. And I want to be able to show that with real data. That hopefully Omega Files 2 or Omega Files 3 will carry.
Omega Files 2, we'll wait for that, and we'll wait to see if the regulator does change its view and there is a level playing field provided, as has been the demand for very, very long now. But Karthik, you know, I've got 10 seconds left before I let you go. Public reaction, at least on social media, etc., to the Omega Files has been a lot of sort of, you know, cheering on and patting you on the back, saying, well done. What's the private reaction been like? Have you been getting DMs saying, what is wrong with you? What are you thinking of?
Yeah, so I get that in a jestful manner. I haven't got any threat mails yet from my peers and colleagues. so I think I'm okay so far. I think the entrepreneurs enjoy this because they have never seen it. So the entrepreneurial ecosystem, the startup ecosystem is like, oh, this is what venture capital actually is in behind the scenes. And uncovering that and unveiling that and understanding it is useful. I think I'm doing the whole industry a service by telling entrepreneurs this is what we do for a living, right? And so don't take our money for granted. Don't use it frivolously. See how difficult it is to return the money. See how difficult it is. You're seeing power law. I'm actually demonstrating power law by the rupee, right? And so you should aspire to be on the right side of the power law, not on the wrong side of the power law. And so I feel like, we'll encourage more entrepreneurs to have that winning mindset, protect capital, and do the community, the VC funds, and the country proud. So that was my hope, really. And so at least the response publicly seems to be that. Yeah.
Karthik, it's been an absolute pleasure. There's plenty more to talk about, but we're out of time on this edition of Young Turks. But thanks very much once again for joining us here on the show and taking us through the rationale as well as the learnings from the Omega Files, the first cut, the first edition. We look forward to many more from you. But for today, thanks very much for joining us. With that, it is time for us to wrap up this edition of Young Turks. From all of us here on the show, goodbye and many thanks for watching.